Welcome to the deep dive. Today, we're jumping straight into an analysis of JPMorgan Chase Co. That's ticker JPM.
Yep. We've got a recent report here, and we're going to pull out the key insights for you.
Exactly. The mission today is simple. Understand the core factors affecting JPM right now, its strengths, weaknesses, and what it all might mean. We'll keep it focused.
Right. We're drawing from that report, including recent earnings, analyst views, the whole picture. Let's get started.
Okay, first up, the stock itself. At the time of the report, the price was listed at $228.99.
And it had seen a small dip that day, about 297 down, or 1.28%.
But here's where it gets interesting. The report pegs the fair value estimate at $239.02.
Yeah, which suggests, a potential upside, about 6.45% from that current price.
The report also mentions its price target, which is slightly different, at $232.06.
Right, so both their fair value and their near-term target are sitting above the trading price mentioned. It suggests they see it as a bit undervalued.
Let's look at some other metrics quickly.
Right.
52-week range is pretty wide, $188.46 up to $280.25.
Big range. And market cap? Huge. $637 billion. Enterprise value over $1 trillion, $1.22 TTM.
And the ratios, PE is 18.49, forward PE a bit higher at 20.37.
And price to sales is 3.1, forward PS is 3.6, price to book 1.84.
So these valuation numbers,
Yeah.
What's the quick takeaway? Are they high, low?
Well, compared to what? You'd need context like historicals or competitors,
Yeah.
but the forward numbers being slightly higher suggest the market is expecting some earnings growth. It doesn't scream wildly cheap or expensive on its own, necessarily.
Okay. Now, the business itself. The report breaks it down into four parts, right? Consumer and community banking.
Yep, CCB. Then corporate and investment bank, CIB.
Commercial banking, CB, and asset and wealth management, AWM.
Exactly. And that mix, that diversification, is highlighted as a real key advantage.
How so?
Well, it provides resilience. If, say, investment banking has a tough quarter, strong consumer banking results might balance things out. Plus, their sheer scale creates switching costs. It's hard for customers to just up and leave.
Makes sense. Let's talk recent earnings then. Q1 2025 looked pretty strong.
Yeah, really strong, actually. Beat revenue expectations. Net income was $14.6 billion.
That's in $5.07 EPS, right? Revenue up 8% year over year. What drove that?
A big part was record equities trading in the corporate and investment bank segment, CIB.
Ah, okay. But despite that strength, CEO Jamie Dimon sounded a note of caution. Something about considerable turbulence.
He did, pointing to geopolitical uncertainty, tariffs, those kinds of macroeconomic worries. So it's a bit of a mixed signal, strong current performance, but definite caution about the future.
And that caution seems reflected elsewhere, too. Net interest income, NII, actually declined slightly year over year if you exclude the markets division.
Right, by 2%. Things like lower rates and deposit margin compression played a role there.
Yeah.
Though the full-year NII guidance, including markets, is still around $94.5 billion, which is actually an increase.
So markets NII boosted the overall outlook. What about costs?
Expenses were up 4% year over year, higher compensation, operating costs, usual suspects.
And they built up reserves significantly, $973 million.
Yes, and that's a big one. They explicitly linked it to caution about a potential recession. Their own economists apparently put the odds at 50-50.
Wow, 50-50. So setting aside nearly $1 billion just in case, that's a clear sign of their outlook.
It definitely is. It shows they're proactively preparing for potential loan losses, even while reporting strong profits now.
Looking at the specific segments in Q1, CIB was the standout.
Absolutely. Number one ranked in investment banking. But even there, the outlook commentary was cautious, citing market uncertainty.
And consumer banking, CCB.
Strong growth in areas like credit card spending, up 10%, and auto loans, up 20%. But again, the flip side was elevated credit costs and that reserve buildup impacting the segment's bottom line.
Asset and wealth management.
AWM also had a strong quarter, pulled in $54 billion in long-term net inflows. Pretty solid.
Okay, let's shift to what analysts are saying. We mentioned the report's fair value estimate suggesting undervaluation.
Right. Their specific fair value is $242.59 in that part of the analysis. Slightly different from the first number, but still above the current price.
But analysts overall seem a bit divided, some lowering targets, some raising.
Yeah, you see that often, especially with macro uncertainty. Truist lowered their target, Baird upgraded, Evercore ISI raised theirs, Oppenheimer lowered. It's a mixed bag.
But the average analyst target over the last 6 months is $252.25.
Correct. So on average, analysts still see upside from the price level mentioned in the report, But the divergence shows there isn't a strong consensus right now.
Which brings us neatly to the risks. The report highlights several: macro headwinds, potential recession.
Yep, that 50-50 chance they mentioned. Also, the impact of those rising expenses on profits.
Sensitivity to interest rates, obviously. Increased credit losses if a downturn hits.
And the geopolitical stuff Dahman warned about. Trade wars, general uncertainty, those are all on the table.
So lots of potential bumps in the road ahead. What about longer-term thinking?
Well, the report notes continued investment in tech and AI, which is pretty standard for big banks now.
Management is also pushing for regulatory reform, apparently.
Yes, and expressing confidence in their ability to navigate whatever uncertainty comes. But they also acknowledge rising competition, even from non-traditional lenders.
Interesting, and a cautious outlook specifically for the markets division despite that strong Q1.
Right. They seem to be saying, don't expect that record performance every quarter.
Let's quickly recap some key trailing 12-month numbers. Revenue, $204 billion.
Net income, almost $60 billion, 59.7 BFA.
BPS TTM, $18.49. Shares outstanding, 2.82 billion.
And the dividend yield was 2.21% with an annual dividend of $5.05 per share.
Okay, so pulling it all together, what's the main takeaway here? Strong current performance,
Yeah.
solid fundamentals.
But facing very real macroeconomic headwinds and expressing significant caution about the future, backed up by that big reserve build. The diversified model helps, but risks are clearly elevated.
So the final thought, maybe something for listeners to ponder. Given JPM's position as a bellwether and their sort of proactive but cautious stance,
Yeah, what does that really tell us about the health of the entire financial sector right now? And, the balance between potential growth versus the risk everyone seems to be bracing for.
that's a really important question to think about. A lot hinges on how institutions like JPMorgan navigate the next year or two.
Indeed.
Well, if you found this focused deep dive helpful and want more concise analysis like this, please do subscribe to the channel.
Yeah, and hitting that bell icon really helps us out, and make sure you don't miss future updates.
Your support lets us keep bringing these insights directly to you. Thanks for tuning in.